Good afternoon, everyone. My name's Susan New and I'm Head of Economics here at the Open University. And we're really pleased to welcome you all to this event jointly organised by the Open University and the Rosa Luxemburg Foundation. For those not familiar with the OU, you might not be aware that it was established in 1969, offering degree courses by correspondence with a mission to make higher education open to all. So we promote educational opportunity and social justice by providing high quality university education to all who wish to realise their ambitions and fulfil their potential. And this has necessarily informed the way that the OU economists have approached research and economics education. So our department has had a really long tradition of pluralist economics education and the promotion of economic ideas that centre power and class. Our latest module, Economics for the Changing World for third years, actually features Rosa Luxemburg several times, amongst other political economists. And over the years, we worked closely with colleagues in the Global South in research and teaching, but we've also been really mindful not to include economic experiences of the Global South in our teaching, but to teach from a global perspective that recognises the history and interconnectedness of the global economy and the dynamics of inequality. We're therefore extremely honoured to be co-hosting this launch of this, what I think is a very important new work by Ndongo Sambasila, Imperialism and the Political Economy of Global South's Debt, at this special event in our seminar series. Just a little bit about our seminar series. First of all, to thank Christina Laskaridis, who is the convener of the seminar series, who've been doing a great job in developing and curating these seminars. And they really have an aim to bring together academics to exchange, share and engage in dialogue with a whole range of key stakeholders in civil society. And we started this in order to bring diverse realms of expertise, all working on current challenges across a broad range of topics. So if you're interested in our future events, please have a look at our website. But of course, today's special event brings together a very exciting group of thinkers. So you're really here to listen to them and not me. So I won't go on any further, but to thank the Rosa Luxemburg Foundation again, all the speakers, and of course, Ndongo for his excellent book. Thank you.
Okay, thank you very much. And I'd like to introduce the volume and of course, all the speakers today in both sessions. My name is Paul Zaremka, and I've been the general editor of Research and Political Economy since 1977. So we've been going on quite a long time. And I just want to say from the very beginning, I've never faced any academic freedom issue, any censorship in any manner whatsoever with anything we've done. I think that's important to say because sometimes things can get quite controversial. Today's volume 38, is really a wonderful volume on imperialism and the political economy of the Global South's death. Now, what I'm going to do is introduce in each of the sessions, three or four speakers of chapters and also discussants one by one. And the first topic will be presented by Juan Santangelo. He's at the University Nacional of Quilmes, in Argentina. And his particular chapter is the political economy of debt in the Global South, the case of Argentina 2001 to 2022. Each of the speakers will have 10 minutes, and I will give them a little bit of a warning as we get to the 10-minute limit. The very first speaker is actually speaking, Juan is in Spanish. Go ahead, Juan.
Okay, well, thank you very much, Paul, Susan, Ndongo. It's a real pleasure to be here. Well, I'm gonna do my presentation in Spanish, but the title is The Political Economy of Debt in the Global South, the case of Argentina 2001 and 2022. Bueno, el objetivo del capítulo...
of this chapter, of this book, is divided into three parts. First of all, it's to analyze the cycle of disindebtedness and over-indebtedness experimented by Argentina between 2001 and 2021. Secondly, it is to examine the ensemble of structural factors and the role of certain national and foreign actors and stakeholders within the process. And thirdly, considering the long-term effects of foreign indebtedness and some lessons that could be learned by other countries of the global south. Here in this chart, you can see very clearly the evolution of three variables. Oops, sorry. Three variables. The black line is the evolution of the GDP, which, as you can see, between 1975 and 1990 is practically in a steady line, but then grew significantly during the 90s until the end of 2000, that is the crisis of 2001. And then we can see the debt process of Argentina, which is represented by the red line. You can see here the evolution of the total foreign debt expressed in millions of dollars, where we went from owing approximately $10 million in 1975 to something like 140 million in the crisis of 2001. Simultaneously, the blue line shows the evolutions of capital flight. As you can see, the process of indebtedness in Argentina was strictly tied to the capital flight process because practically all of the debt went abroad. Yes, capital flight. Argentina has a quite particular relationship with the International Monetary Fund. Argentina became part of the fund in 1956 within the framework of a dictatorship that had overthrown Peronism, the Peronism of Perón, which had always been opposed to being part of the IMF. Although the agreements with the fund are usually an exception, Argentina has signed 29 agreements between the periods of 1956 and 2016. So this is part of certain agreements that include extended facility agreements. So this is a long history of debt and of growth, of course, of this debt process. So within this context, Kirchner took over and his administration was the first attempt to apply modification of the regime of accumulation of financial hegemony, which had been the case between 1976 and 2002. This led to a process where the state became important again as a relevant actor in the economic life. And of course, leaving behind the political formulas promoted by the Consensus of Washington. And this was imposed over the neoliberal policies. And this was a result of the play between both aspects. In terms of indebtedness, the Kirchner administration had three major milestones. First of all, the debt restructuring in 2005, which was extremely important. Secondly, the anticipated payment of the debt to the IMF, worth $9.8 million in 2006. And this was in articulation with other governments, example, Brazil, and during Cristina Fernandez's administration, a debt restructuring in 2010. And thanks to these three milestones and these processes, there was a sharp reduction of the debt level in Argentina. So the process of debt restructuring was very successful. Once this administration came to its end, for the first time in a very long time, a right-wing government led by Mauricio Macri came into power. This was a coalition which was able to reinstate neoliberalism in Argentina with a very clear goal, which was to transform Argentina quickly into a market economy. That was its main goal. So it took the main measures taken by right-wing governments, yes, opening up the markets, liberal.
les importations, des taxes, et 9,3 millions de dollars de fonds. C'est un montant que Mme Kushner voulait pas payer. En 2018, ils ont signé également un nouvel accord de 57 milliards de dollars. C'était le plus grand prêt de l'histoire, avec 44 milliards de dollars, qui représentait plus de 200% de dette. Et donc, cela a renforcé la capacité de l'Argentine à contracter une dette avec le soutien des États-Unis. L'Europe était opposée à cet accord, mais à cause de la pression de Donald Trump à l'époque, l'accord a été approuvé. Plus, Marquis n'avait pas aussi respecté les exigences légales du pays approuvées par le FMI et il n'a pas vérifié de l'approbation du Congrès. Donc, c'est un mouvement de l'administration au niveau de la dette.
Government and the agreement with the fund in 2018. So these are the disbursement of the IMF per year in Argentina between 1980 and 2021. It is a country with a high level of debt, as you can see in the first chart, but only in 2 years, Argentina received 65% of everything it had received in the past 30 years. So that is absolutely crazy. And this is the same that happened during the dictatorship during this process. Almost all debts went for capital flight, as you can see in this chart. And also there was a bit of a scheme where the maturity calendar was absolutely impossible to comply with for Argentina. Argentina had to pay almost $300 million, which is approximately 70% of the GDP of 2019. So it was impossible to pay. So the program basically was impossible to fulfill, and the following government, of course, wasn't able to do anything with this. Within this context, Alberto Fernandez, again with a coalition, won the elections in 2019 with Cristina Fernandez as a vice president. And he denounced Macri's actions with respect to the debt, but still decided to pay. Basically, what he did was renegotiate the maturity dates. There was a major debt reduction, also agreeing with the private sector. And what this generated was a new profile of maturities for the debts. You can see here the evolution of the total debt in relationship or with the ratio with the GDP. The ratio is that red line. You can see how it goes down during the governments of Kirchner and Cristina Kirchner, how it went up with Macri. And so the only thing that this agreement achieved was basically to change the profile of maturities. That is basically the only thing. In red, the original maturity dates, in green, the new ones. But it was and continues to be impossible to pay and to fulfill this schedule. First of all, the IMF is an instrument of domination and exploitation. These are the lessons learned from these processes. And it has been used throughout history in Argentina to subordinate any aspiration to development. The IMF is not an impartial organization. It is controlled by the United States, by the central countries, and its purpose is to consolidate a long-term domination of neoliberalism and the global capital in the region. The process of indebtedness carried out in Argentina by the government of Macri had the central goal of restructuring any future aspiration to development, so that any government that came afterwards was strongly conditioned by this decision to take debt. And achieving this this conditioning was the main objective. Therefore, the endless cycle of debt, or the apparent endless cycle of debt, leaves us with a lesson for the global south, which is that the political struggle is essential, because you can pay debt, you can escape the domination of the IMF, but for that you need a very strong working class. Thank you very much.
Okay, the next speaker is also in Argentina. It's Mariano Felix at CONICET in Argentina, and he will be speaking on, can debt be sustainable if life isn't? Argentina's debt crisis and social reproduction.
Thank you, Paul. Thank you, everyone, for being here. Well, especially thank you to Ndongo for the invitation to be part of the book and to be part of this presentation. I will try to make my presentation briefly in English. I'm sorry if my English is not very good. The idea of my chapter is very much in line with what Juan has presented just now. But I try to get deeper into the idea and the discussion about what are the implications of the debt, especially foreign debt, being sustainable, as the IMF, International Monetary Fund, presents this concept. And I try to debate whether this can be done in a country such as Argentina, in a dependent economy. And I say dependent economy because I work very much in line with the Marxian dependency theory that was born in Latin America in the 60s and 70s, and I'm working within that general theoretical framework. At the beginning of the chapter, I present the connections between debt and dependency in Argentina, much in line with what Juan explained for the long run. I concentrate myself in the last few years of increasing indebtedness of our country and the latest renegotiation of external debt, especially the renegotiation of the debt with the IMF. I then go on to present this. Do you hear a noise on the back? No, it's okay. Then I go on to discuss the idea of sustainability of debt as presented by the IMF. They understand this as the ability of a country to be able to remain within the system of debt, or that is to remain indebted in the long run. And this, of course, implies to be subject to the need to adjust its policies to the need to pay and repay eternally its debts. So this is the main concept of the IMF. I present some of the debates in the local debates around this idea of sustainability of debt, especially the debates that were presented here in my country in the 80s, because I think those debates were put to the front some ideas that are important to understand the relationship between debt sustainability and life's unsustainability. In these debates in the 80s, especially the theoretical frameworks in many of the theoretical frameworks in my country presented the idea that for debt to be sustainable, profits have to be, on the one hand, very inflexible, rigid, as well as the consumption of the rich people in the country are rigid. That's the assumption. At the same time, the sustainability of debt implies that wages must be very flexible, and especially wages in a very general sense, in the sense of all of the work that has to be done to reproduce life, more than just money wages. So these are the conditions for debt sustainability: rigid profits, but very flexible wages. And this articulation between profits and wages is not easy to attain, and the IMF and the Argentinian governments are very clear on this, that the social and political conditions for this sustainability are not easy to attain. And I discuss some of this in the article. Well, what it is clear, my understanding is that making debt sustainable, especially external debt, implies promoting austerity, adjustment, and structural reforms that tend to increase the care crisis, the crisis of reproduction, of care and reproduction within the country. And this in at least two dimensions. On the one hand, the pressure to repay debt and the adjustments that are required to repay debt and to remain within the debt system, create increasing pressures on activities on the work of care and reproduction that is borne by women and feminized bodies across the country. All of this, of course, increases the crisis of care work in general terms. And at the same time, another dimension of this relationship between debt sustainability and life and sustainability has to do with the need of increasing the number of extractive projects to pay debt, to create exports, to gain dollars or euros, and then to use that to repay the debt in the world markets. But at the same time, these extractive projects have a very important role in providing, supplying minerals, energy, and other materials for at the current time for the green transition in core countries. So at the same time, debt sustainability creates the need to export, to gain money, in international global money, and at the same time to provide core countries and core corporations with these materials that are so very important at the current time. And what I try to discuss later in the article are the direct and indirect effects of these measures or these two lines of thought. The direct effects of austerity have to do with the reduction of public expenditures, and I analyze what has been happening in Argentina since 2018, when the last increased debt with the IMF. And I also analyze how there has been a very great reduction in the expenditure, public expenditure in areas of reproduction of life, social programs, education, and health, for example. But there are also several indirect effects of austerity that I also try to relate to the reproduction of life that have to do with the increasing precariousness in the labor markets, the increasing number of people migrating, whether internally within the country, but also internationally, and also the relationship between the need to pay for debt, the increasing number of extractive projects, and the destruction of the environment, the increasing cost in terms of health of the population, health of nature, health of animals in the areas where these extractive projects are cited. What I try to present in the article as a whole is to show how the need to remain within the debt system through the idea of debt sustainability tends to increase what's called within the Marxian dependency theory to increase the super-exploitation of labor, not just the exploitation of labor, but the super-exploitation of labor, which is a particular concept that relates to the increasing number of people working in poverty, working in very and increasing precarious conditions, the increasing number of people working without an income, or especially women at the households or at the communities. This is something that I stress very, very much. And of course, in general terms, I stress how this process is tied to the destruction of people's conditions for reproduction and also not the natural conditions for reproduction. So this is more or less what I present in the article. I think the core idea is that we have to relate to understand that making debt sustainable in the terms that the IMF and in general terms the governments have tried to put it in Argentina at least, and well, the IMF worldwide, has a direct effect, a direct negative effect in the possibilities of an adequate reproduction of life in general, life of women and men, of people, but also the life in relationship with nature as a whole. So that's the main idea of my article. That's it. Thank you very much.
Thank you very much, Mariano. We appreciate your very timely presentation. And now we turn to Harry Cross, who's at the Ford University in Saudi Arabia. And he is speaking, just let me catch it a minute, colonial hangover in global financial markets, Eurobonds, China, and African debt.
Good afternoon, everyone.
No, sorry, I got that wrong.
It's not totally unrelated, so I wasn't sure if I should correct it or not.
Yeah. Go ahead.
Well, hello, everyone. Thank you very much for the introduction. So I'm talking, those topics are unrelated.
I want to be responsible and change the title to the correct title.
That's fine. We can cover it up because, you know, thematically it's related. So we'll pretend it was part of the schedule. But specifically, I'm talking about the case of Sudan, including touching on those themes mentioned by Paul. So thank you very much for the introduction. Thank you for having me. Well, it's always a pleasure to speak about Sudan. It is unfortunate that the topic is so grimly topical with the violence and confrontations that we've all seen in the news this week. While I cannot say that the economic factors that I'll be discussing directly caused any of these political and military events, they certainly combine to the context in which these events are taking place. And indeed, many of the missed political opportunities in Sudan in the past 4 years since the popular revolution against military rule in 2019. So the first point I wanted to make is that many of us who work in a critical political economy, and especially in a comparative perspective, we take certain things for granted, namely that sovereign debts and interventions by multilateral creditors should not be understood as something technical or purely economic, but as something political. And as mentioned by some of the earlier speakers, that bodies like the IMF and the World Bank have been captured by the economic and political interests of the United States and their resident investors. But while we may take this as granted in our own fields of research, something that's very striking for me is how little this filters down into academic case studies of Sudan by specialists of Sudan. And I can think of really excellent historical and political and cultural studies of Sudan, which nevertheless, when it comes to explaining economic events, will fall back on blaming either the incompetence or the corruption of the governments in place in Sudan at the time, which I think is, and I think these moralistic terms of incompetence and corruption have very little explanatory value. And in the case of Sudan and many other countries, they miss what is entirely typical of the experience of a post-colonial economy. So in the case of Sudan, an increase of indebtedness from official creditors and multinational banks in the 1970s, the double shock of rising oil prices, so the rising cost of inputs following the 1973 OPEC oil price shocks, rising interest rates after the Volcker shock, combined with their own fluctuations in export receipts due to fluctuations of primary commodity prices within international markets. Such that by the end of the 1980s, Sudan and many other post-colonial countries have this huge sovereign debt overhang, as it's called in the literature, that they're struggling to service their debts, let alone pay down the principal. So that every form of foreign creditor intervention becomes a form of life support, rather than us being able to imagine a point at which they pay down the debts. And in Sudan specifically, they default on their debt payments at the beginning of the 1980s. A new government in 1989 attempts to bring debt payments back online, including to the debts that had been defaulted upon, but is unsuccessful in doing so for reasons I'll discuss in just a moment. What is particular to Sudan is not how the country manages its external accounts in this period, but the rise in 1989 of a government, a military government, a very brutal government, run by the Muslim Brotherhood and their allies in the Sudanese military. And they try to build their particular vision of an Islamic political economy. And they're very successful in doing so, in transforming the entire financial sector into an Islamic banking sector, financing small and medium-sized enterprises, often with links to the regime, breaking some of the corporate monopolies that had existed through previous political regimes in Sudan. And although the government is very violent in how it maintains political power in this period, It also gains a certain level of legitimacy from some sections of the population by engaging in an economic democratization, opening up the corporate sector to smaller sized participants, and embedding the economic system within a different set of values, as it understands it, a set of Islamic values. Sudan is also pursuing an independent foreign policy in this period, hosting Osama bin Laden, supporting Saddam Hussein in the First Gulf War, supporting Palestine against Israeli occupation, in a period where elsewhere in the world, US foreign policy hegemony is at its height. So in 1997, Sudan has a regime of sanctions, economic sanctions placed upon it by the United States and the West. And this renders definitive the failure of Sudan's attempt to repay its sovereign debts it had contracted up until that point. So we have a very interesting combination of a government that rhetorically and politically places itself outside of the Western-centered geopolitical order, but which economically is still trying to be a good student of neoliberal orthodoxy and IMF and World Bank-led orthodoxy. Sanctions in Sudan, as in many other places, do not have the desired effect. They impose material hardship on the Sudanese population. They do little to weaken the regime. In fact, we can interpret this as a protectionist shock that's imposed upon the Sudanese economy, thus that it forces a form of delinking from the global economy, and the government is able to leverage this to choose who will be the winners and losers of a new economic order that's more divorced from outside economic connections and flows of financing and commercial and capital credit. Okay, I'd like to jump ahead now to recent events and 2019 onwards in particular, since the book covers the 21st century history of third world debts, and because this is a particularly important period for Sudan. So in that year, in 2019, there's a popular uprising against military rule, against the military power that has been in place since 1989. And in the course of that year, the Sudanese military turn against the president and introduce a transitional process with power sharing between 50% of ministerial positions going to either the official military or various paramilitary groups, which are the two groups now fighting each other in Sudan. And then the other 50% of ministerial portfolios going to civilian representatives, either representatives of Sudan's old political parties or, crucially, technocrats. But of course, to call them technocrats is to pretend that they're apolitical on a level at which they are not. So both the Prime Minister and the Finance Minister in Sudan, these portfolios are given to former international economists from the IMF and the World Bank. And very little of the so-called critical scholarship on Sudan has questioned this and questions how that has embedded certain political visions within Sudan. There was supposed to be a 3-year political transition towards elections and the full restoration of civilian rule, for which we are now overdue. But during this year, we could notice with surprise, perhaps, that the transitional government was making quite major policy decisions. It was not merely managing the country and the political restructuring towards the organization of elections. It was undertaking quite major economic restructuring. Notably, for example, by announcing that the policy of subsidy renewal, which had led to the protests that had brought down the previous military government, was to continue. So even though there'd been a change in government, the austerity-driven economic policies were not to change under the transitional government. And this was not coming from the military portfolio holders, the civilian portfolio holders. And the policies were, of course, prescribed by the IMF and Western creditors. So why was this? It was because, of course, Sudan wanted to use this opportunity to reintegrate into Western market systems, to regain access to Western capital and commercial aid. But this involved obeying Western policy conditionalities. So this had already been the policy logic under the previous regime. It continued to be the policy logic under the transitional regime. But now this was presented as a key part of the transition, a key part of Sudan's political redressment, despite the paradox that, of course, it was a policy of extreme continuity. We then saw the circus of different Western governments and so-called supporters of Sudan's democratization and process of political transition, engaging in what was framed as debt cancellation and debt forgiveness. But of course, this did not concern debts that Sudan was currently servicing. It concerned debts that Sudan had defaulted upon since the 80s. And this is something we see in very many countries, that so-called programs of debt forgiveness only concern official debts, so debts that are at the forefront of the priority for repayment to creditors, and they do not concern private debts, so it enables private creditors to get their demands of repayment to the front of the queue. And it also concerns debts that have been defaulted upon since a very long period of time, so not debts that Sudan was currently seeking to foreclose upon. So finally, by way of conclusion, this set of policies is something that has imposed continuing economic hardship on Sudan and protests against the government's policies before the renewed military coup in October 2021 and the frustrated attempt to restore the political transition that has happened since then. So while I don't want to say that economic factors have directly caused recent political events, they've certainly helped to lead to the failure of political transition. This is a story of the structural power of Western creditors in Sudan. And yet, when we zoom in on the detail, we can see that it is not just about the technical aspects of economic interest. One could imagine a sort of enlightened capitalist policy by Western creditors, where they decide to suspend interest payments on Sudan's debts and allow Sudan's outstanding debts to deflate away through inflation on balance sheets. But instead, the unrepaid debts are never, ever written off. As Dr. Patricio, the discussant for the second section, as her research highlights, there's no process with sovereign debts to write off debts. A country cannot declare bankruptcy, cannot default on its debts, and have these debts written off. So we must imagine a situation, the best case scenario for Sudan, where political transition is restored, these former debts will come out of the drawer again and be revived. And so we see this cycle in Sudan where what appears to be good news on the level of political events is always bad news on the level of debt, because creditors use it as an opportunity to press debts, to blame the corruption and mismanagement of former regimes, and the new regimes in place legitimize this discourse, as do so-called partner allies and institutions, be they NGOs, be they academics, be they foreign governments, which present debt repayment and debt restructuring as part and parcel of political transition and democratization, when this should not be the case. So thank you very much.
Thank you very much, Harry, who was talking, and I'm going to give the title correctly this time, Tightening the Grip, Foreign Creditors and Sudan's Political Transition 2019-2022. And now we turn to the editor of the entire volume, who has been very wonderful to work with over the last maybe year and a half, I guess, on this. That's Nnugo Sambasila, who is at the Rosa Luxemburg Stiftung in Dakar, Senegal. And he will be making some remarks about the volume overall, and in addition to his own chapter, which is Imperialism and the Global South's Debt, Insights from the Modern Monetary Theory, Ecological Economics, and Dependency Theory. Go ahead and don't go.
Thank you, Paul. Good morning, good afternoon, everyone. I will start first by thanking the Open University and the Rosa Luxemburg Foundation for having made this event possible. I am very grateful to Christina Laskaridis for all her efforts in organizing this event. I also express gratitude to my irresponsibility colleagues, Jenny Wedraugo, Andreas Bohn, Arif Rusgar, Loting Torge, and Lauren Balhorn. Thank you as well to Paul Zaremka as the editor of the Research in Political Economy series at Emerald. Paul provided the editorial space to publish on this timely topic and provided me with intellectual and moral support during the whole process. The volume would not have been possible without the contributors. I learned a lot reading their chapters. I am thankful to all of them for their solidarity and their patience. The chapters of the volume were peer-reviewed. I could not thank enough the colleagues who helped to enhance the quality of the selected contributions. I would like also to thank our discussants today, Charles Abugri, Karina Patricio Ferreira Lima, and James Gatti. Some comrades are also attending this event, Debt for Climate, Aphrodite, CIDTM. Their solidarity is well appreciated. Imperialism and the political economy of Global South debt aims to revisit the issue of Global South external, that is foreign currency debt denominated foreign currency, with a particular focus on sovereign debt. The starting point of the contributions gathered here is the recognition that Global South external debt crises are structural in nature. As such, they could not be explained away as a result of mismanagement, fiscal irresponsibility, etc. These idiosyncratic considerations are potentially aggravating rather than structural factors, helping account for the longevity and recurrence of this problem across the Global South. The focus on structural factors does not imply that there have been no new developments. The emergence of China as a global lender and the economic and political weight of Eurobond holders like BlackRock, one of the biggest asset management companies, are important developments that have been analyzed in the volume alongside factors such as commodity dependence, global financial volatility, class structure, creditors' power, etc. The volume contains 9 chapters organized in 3 parts. The first part gathers 4 case studies. You just heard Juan Santangelo, who wrote this paper with Juan Manuel Padin, Political Economy of Debt in the Global South, the case of Argentina. You also heard Mariano Felix, who wrote Can Debt Be Sustainable If Life Isn't? Argentina's Debt Crisis and Social Reproduction. You heard also Ari Cross, who wrote on the tightening the grip, foreign creditors, and Sudan's political transition. And you will hear in this part case studies Olufunmilayo Arewa, who wrote Colonial Hangover in Global Financial Markets, Eurobonds, China, and African Debt. Part 2 of the volume deals with the elusive case for a sovereign debt mechanism. We have 2 chapters here, one by Christina Laskaridis entitled Refusing to Improve, Sovereign Debt Repayment Difficulties and the Political Economy of Inertia in UNCTAD 1964-1979. Another one in this part is by Milan Riviere. Unfortunately, he's not with us today, but he wrote a very interesting chapter called Limits of Sovereign Debt Restructuring Mechanism and Possible Alternatives. Part 3 is entitled Foreign Debt Development and Imperialism, and we have 3 contributions here. Basil Oberholzer wrote on managing the balance of payments, constraints, dilemmas, and perspectives. I have offered chapter 8 on imperialism and global south debt, insights from modern money theory, ecological economics, and dependency theory. And last but not least, we have a chapter entitled The China and Debt Trap Diplomacy, a brief assessment by Shalendra Sharma, who is not here, unfortunately, but he apologized for not being here today. So I will briefly summarize my chapter in 6 points. My chapter has been rather theoretical. The first point is that we have to acknowledge that the most indebted countries in absolute and relative terms are not those that suffer debt crisis. Japan had a sovereign debt GDP ratio of more than 250% in 2020. Yet there is no sovereign debt crisis in Japan, and there won't be one. By contrast, defaulters such as Argentina, Belize, Zambia had far lower debt GDP ratios when they defaulted on their obligations. What this shows is that the debt crisis endured by some global south governments reflect above all their subordinate economic and monetary status. Issuing sovereign bonds in a foreign currency is an indicator of a low economic and monetary sovereignty. Indeed, governments that are monetarily sovereign are those that do not have to issue debt instruments in a foreign currency. Monetary sovereign governments such as Japan, the US, Canada, Australia, etc., face no solvency risk, and in principle, their central banks have a degree of control over the interest rates that apply on their bonds. That is not the case for most of the global south countries. This explains that they can default on their foreign debts despite being less indebted than the richest countries. The second fact is that currency issuing governments could not lack their own currency. Better, everything that is technically and materially feasible can be financed in the national currency. In other words, global South countries do not need to issue debts in foreign currency to finance projects that require real resources that are locally available or that can be developed locally. For example, if they want to build schools, health facilities, etc., and they have all the technologies and material required, in principle, they face no intrinsic financing constraint. They need not issue debt in foreign currency. By contrast, they might have a financing constraint if the projects they want to implement require real resources that are not available locally. In that case, they need to have enough foreign exchange to have access to those real resources. Now, a common view interprets Global South's chronic external indebtedness as a result of a lack of foreign exchange, a lack of US dollars. This view has to be nuanced, because most Global South countries usually manage to generate significant inflows of foreign currency income through their exports. However, their export income is often controlled by transnational corporations. I argue that transnational corporations have a first claimant right over southern countries' export income, given that they usually control their export sectors. This first claimant right is manifested in the repatriation of profits and dividends and other fraudulent practices resulting in illicit financial flows. The third fact to acknowledge is that profit and dividend repatriations are often higher than interest payment on the external debt, and sometimes higher even than the public external debt service. This has been the case for Africa during the period from 2000 to 2018. Africa suffered financially much more from profit and dividend repatriations than from the servicing of its external debt. This financial bleeding explains to some extent the need for African countries to issue debts in foreign currency. If the financial resources transferred abroad were instead invested domestically to spur their food and energy self-sufficiency, as well as their industrialization, this would certainly lessen the need for them to issue debts in foreign currency, or at least that would spare them from debt crisis. The fourth fact to acknowledge is that the cancellation of the external debt stock of the Global South countries is not an affordability issue for the Global North. Indeed, the Global North can afford to cancel completely the external debt stock of the 133 countries ranked as low and middle income countries, China, India, Russia excluded. In 2020, the external debt stock of these 133 low and middle income countries, China, India, and Russia excluded, stood at $2.6 trillion, a figure lower than the federal debt of the Canadian government. In 2020, the debt service of the low and middle income countries stood at $20.76 billion, while the OECD governments issued debts valued at $18 trillion for the year 2020 only. So the question, can the Global North afford to cancel the external debt stock of the low and middle income countries? The answer is yes. To the question, will the Global North accept to cancel the external debt stock of low and middle income countries? My debatable answer is no, because the debt system is highly profitable to the Global North. The fifth fact to acknowledge is that we are living in an imperialist world. This could mean many things. I have in mind one precise thing. Global South countries transfer net income to the Global North. By net income transfers, I mean net interest payments plus profit and dividend repatriations. In other words, a significant part of the production happening in the Global South belongs to the Global North and its companies. Global North countries and their companies are like shareholders vis-à-vis the production happening in the Global South. Countries such as the US, Germany, and Japan receive net income from the rest of the world. For Germany and Japan, the net income coming from the rest of the world represented something like 3% of their GDP before COVID-19. For the US, the net income transfers went from $150 billion in 2000 to nearly $450 billion in 2018. We could say that these are imperialist countries because they receive a tribute from the rest of the world. They benefit from a permanent Marshall Plan from the rest of the world. Given this pattern of net resource transfers from the poorest countries to the richest one, we can understand that rich countries always oppose significant debt cancellation and the establishment of a sovereign debt restructuring mechanism. My last point is that I am highly sympathetic to the agenda of debt cancellation. Debt cancellation, if it happened, would provide relief to the global South populations as they usually suffer the consequences of austerity policies. However, there is a difference between canceling the current debt stock and canceling the debt system. By debt system, I mean the structural conditions that explain southern countries' financial fragility and vulnerability to debt crisis. Canceling the external debt stock does not cancel the debt system. To cancel the debt system, a national and democratic control over economic resources and the domestic financial system, as well as an increased socialization of investment, are required. Thanks for your attention.
Thank you very much, Ndongo. And now we move into the opportunity to have some discussion about any of the topics that have been presented so far today. First, we have a scheduled discussant, Charles Gubra, sorry, who will be given more or less 10 minutes to say what he would like to say. He is a Ghanaian economist and executive director of IDAs. Charles, please go ahead. And then afterwards, I will try to be able to host or co-host some kind of questioning by anybody else in the audience.
Thanks very much, Chair. My name is Charles Abugre, and IDS is the International Development Economics Associates. It is a network of largely South-based pluralist economies. This has been operating for over 2 decades now. First, to say thank you very much for the opportunity to listen in fact, and to make a comment. I think the book, which I'm looking forward to reading, could not be more timely. I just actually on my way from the spring meetings of the IMF and the World Bank. And although that was not necessarily at the center of the political discussions, it was an essential part. And I heard the IMF managing director make the point that nearly 60 countries or so are either are defaulting, at a very high risk of defaulting, or at a medium risk of defaulting. I mean, we are talking about nearly a third of the members, and that means that we are actually talking about a serious rising, crisis of external debt and so on. But why is it not that in spite of so many countries being at the risk of default and queuing up for debt restructuring of one form or the other, there isn't much of a scare, of a fright. It is simply because these countries put together, mainly low and lower middle income economies, collectively do not have adequate financial weight and potential damaging impact if they default on the global financial system. That brings me to the point that's been made by all 4 speakers, which is that debt and debt dynamics are essentially shaped by power and power relations, and similarly, the institutional frameworks currently existing to address them are products of power and historical geopolitical dynamics. So this is important to keep in mind and to reflect across all of the papers as we've had. If we, I think it was Yuan who, when he opened up, he made the point that the Argentinian debt crisis is essentially structural. And I think that point was also repeated by Ndongo across the place. And in fact, all parties. It's structural in many ways. It's structural in the way that Ndongo described it, which is partly that these economies are in subordinate positions, that actually we are talking about their inability to drive sovereign policies, and that they are dependent on international markets. They do not have the productive capacity to develop autonomous economies, and for that reason, and that is partly reflected in the very nature of the debt instruments that they contract. So they contract debt largely in foreign exchange. They issue their bonds to finance even their budgets in foreign exchange, much of which expenditure does not need foreign exchange, or the ability to generate foreign currency to finance relevant imports is constrained by the structure of those economies. So there is, and for many of these economies in Africa, and I think even for Argentina, it's largely rooted in commodity dependence and the volatility in the commodity markets, that their productive capacities are weak. Their ability to control, to sustain technical change, and therefore, which is reflected in their control and development of technology, and to apply that technology in manufacturing to diversify even their own productive export capacities are weak. So I think it's important to keep in mind the Ndongo's final point, but also a point that was made by Yuan from the beginning, which is that there is a difference between the debt and debt restructuring and relief on the one hand, and the capacity to avoid the future debt on the other, which has to do with the structural constraints facing these economies. The story of Sudan is very interesting, because Sudan, what we forget is that Sudan is a very commodity dependent economy. Part of went into war for many years, and that's partly rooted in the struggles over the control over oil and oil revenues. And it is an interesting place, positioning in geopolitics, African and Arab, with all sorts of demands and pulls and pushes that affect the Sudanese economy. And so the Sudanese economy has faced structurally the same dynamics as the economies of the rest of Africa and the economies of commodity dependent countries and so on. And so in a sense, it's been in crisis for a very long time, which is a combination of many crises. And I think one of the first uprisings that are associated with a protest against IMF reforms was Sudan, and that was the bread crisis of the 1980s. So I would like to emphasize the point that was made by Harry, which is that the current crisis, it's actually partly a reflection of a continuous economic crisis, which has also been reflected in political crisis with geopolitical involvements and implications as well. I think we do need to also recognize that has been a shift in the nature of the structure of debt, and therefore for many countries, especially in Africa and South Asia, and therefore also reflects the structure of power and geopolitics that has to be addressed as part of the debt restructuring process. And that has to do with economies that are exceedingly weak, being enticed into global bond markets by liquidity that is flashing around, as a response to the global financial crisis that drove interest rates below zero, and therefore made it attractive to borrow. And in fact, many of the arrangements with the IMF had with economies that were looking for temporary and bridging funds. Economies are actually actively encouraged to go into the private bond market, and that is supposed to be a mark of progress. And so many countries from Benin to Zimbabwe to Sri Lanka, gobbled up the external bonds. And so we have a situation now that the debt structure for countries that have had very little experience with dealing with the power of the private investors, equity investors, now find themselves tied up with equity investors. The institution that was supposed to facilitate a relationship, facilitate a coordination of the players for resolving these debts, the IMF, finds itself now basically clearly playing a role of acting as a guarantor for the private creditors. And so new debt restructuring arrangements now require that debtors reach an agreement with a complex array of private creditors, with the multilateral institutions declining and have declined to date, to contribute to any form of haircuts that enables any of these countries to bounce back, even if temporary, as was the case of Argentina. Now, there is also, as we look forward, another development in the debt dynamics, which is the experience of Ghana, and that the current negotiations in Ghana, which also has direct implications now to the likes of Sri Lanka and many countries coming along, which is that debtor countries must now undertake domestic debt restructuring as a prior action and precondition for accessing IMF support and any form of debt relief. And that prior action is basically to create haircuts for domestic creditors, many of which are pension fund holders, workers' funds, and so on. And so workers in debtor countries are increasingly directly asked to take the burden of debt in order to avoid any form of haircuts with international bondholders. So the point that was made about Mariano made about the differences between the debt sustainability and the sustainability of life and society has become accentuated in a sense that it is now not only the austerity threats to social reproduction and to economies, it is also that even workers, the small savings of workers and savings of individuals in their domestic banks are now
Charles, can you-
directly targeted. I shall end. Are now directly targeted for haircuts in order to sustain the profits and the capital of foreign bondholders. So we have a situation that eventually now that the debt has become even more clearly an instrument of multiple subordination. This subordination becomes very insidious, especially with smaller economies who collectively, though do not threaten the international financial system, become a symbol of control generally. And yet, as the point was made, there isn't a system or international system in which debtors have a voice in debt restructuring. And I think probably it is time, as we look forward to the next session, to hear about the role of how debtors and the debtor countries themselves can create the political mechanism through a form of cartel or the other to balance the political dimension to become a counterweight in the political framework for debt restructuring. So I'd like to thank you very much for these presentations, and I look forward to reading the book.
Thank you very much, Charles. And now we have almost 20 minutes for open discussion. And what I propose is that anyone who would like to ask anyone on the panel a question, that they use the raise hand function at the bottom of your screen. And I'll call on people in the order that they come up. If you need to, you can also use the Q&A function, but I prefer actually the raise hand method. So now it's open to anybody to ask any questions or make any comments. Okay, go ahead, Praveen Yavid.
Sir, what's the challenges to overcome the global economic political scenario, sir?
Okay, Robin Jasper says hello to everyone. Hope the Q&A is okay. Bad connection today. Thanks a lot for the very insightful inputs and your work. Really looking forward to read the whole volume. It will be an essential resource for the coming political struggles for sovereign debt cancellation. I have two quite broad questions to whomever feels like answering. One, how does the imperial sovereign debt nexus relate to the currently unfolding climate crisis in your perspective? How can we strive towards an analysis that is able to grasp both developments? And the second question is, which role do you attribute to the rise of restrictive monetary policies and quantitative tightening by the Fed and the ECB regarding the current distress in the global South's debt markets? I am particularly interested in the de facto link between Western and Central African currency zones with the ECB's key interest rate. I would really appreciate a comment by Ndongo regarding this the last one. Then there's a comment by Sabrina. What kind of concrete political solutions are currently proposed in terms of monetary sovereignty for countries of the South as an alternative to the USD, the US dollar? For example, can the SUR currency proposed by Argentina and Brazil solve the problem? Then there's a question by Pablo de la Cruz. What do you think about the proposal of the Colombian president of exchanging debt for climate action? That's it.
I think that's enough for that. We now have four
great.
questions, so let's hold off for a moment. Does anybody want to address any one of those? Anyone on the panel?
Well, they're very interesting questions, all of them. What are the challenge? I'm gonna talk about two of the questions. The first one, what are the challenges of the global economic scenario? I think they are, there is a very interesting opportunity for the global South right now. The hegemonic dispute between the US and China, I think it opens a window for the countries of the South to, especially if they are able, which is the hard part, if they are able to put themselves in a position in which they can get what they need. I think that there is a very important issue that most of the countries, we don't have a clear diagnosis of what we need to do. But I think that every time there is a huge dispute and a huge transformation in the global market, in the global hegemony of the world, as it seems right now with China and the US and the war in Ukraine and Russia and everything, I think there is a good opportunity. It will be great if the global South can act as together. We have in the 80s, Latin America tried like what was called debt club countries or something like that. And they try to negotiate with the IMF and the powerful countries all together. I think that that will be nice and maybe a good opportunity to do that or something like that. And the other thing which relates to the Argentine and the Brazil currency, I don't think so. I think that is not gonna solve the problem at all. I don't know if it's I think that the main problem is much more deeper, and it's related to structural issues like the subordinate position that the country has and all the things that we were discussing, the dependent situation in which most of the South countries indebted we are. So I think we need to change the structure, which is a very difficult issue, and we need a lot of planning to do that, and a lot of political commitment and support from the working class to do that. And we are, unfortunately, at least in the case of Argentina, we are far from that situation.
Does anyone else want to answer?
Yes, I'd be happy to make a comment on several of the points that have been made. Both Charles's question, some of the speakers about what mechanisms for addressing these problems. Obviously, what we hope for is sort of collective negotiations by debtor club countries, as Juan mentioned, with the threat of collective default. And I think we need to keep calling for that in our academic work and our political work. It's also clear that's not for tomorrow in terms of that level of coordination between countries and critical political movements within each country. So we have to also imagine what we might expect in the shorter term rather than what we want. Now, what a lot of us have discussed Western structural power in the global political economy and the capacity of the United States in particular to dictate the terms of debts and debt repayments and the use of the US dollar. Now, while this may serve the technical interests of the US, there's also an extent, as I said, to which it's also about embedding certain normative values, that debts must always be repaid and you cannot default on your debt. Your debts might be forgiven, but they can't be defaulted upon and cancelled. Now, one of the paradoxes of that is that if countries like Sudan with very weak negotiating positions in the international economy are simply frozen out of Western-centered systems of capital and commercial credit, they turn elsewhere. And other countries that are able to provide short-term liquidity consequently gain a great deal of domestic political leverage in Sudan. And we can see that with other chronic surplus countries. Well, the US is a chronic debtor country, but chronic surplus countries in the global economy, notably in the Arabian Gulf and China in the extraction of crude oil in the early 2000s, and the Saudi Arabia and the UAE in the purchase of port facilities and agricultural land in Sudan are extremely influential. And for them, Sudan is a crucial country because it's in their region, their neighbors. So while the West is playing this game of structural power, other people are being able to play geopolitical games as well as economic gains in Sudan to benefit from the fact that Sudan has few other options. Now, what we've seen more recently that's very striking is a rapprochement between Arabian Gulf states and China. China's made certain high-level visits to Saudi Arabia to discuss new rules of the global economic game that could bypass the US. If the US and the West are sanctioning Sudan, then that's a problem for Sudan. If they're sanctioning Russia and China and Iran and Sudan and many other people decides, then it turns out they woke up one day and they're sanctioning themselves, and there will be parallel economic systems in play. Now, we mustn't get excited. Saudi Arabia and China are not going to blow up the US-centered economic system tomorrow because their central bank reserves are primarily made of dollar-denominated assets. But for much smaller countries like Sudan, could quite easily get to the point, or maybe already are at the point, where they have no practical route and no interest in dealing with Western creditors and turn towards an alternative system only. And to the extent that they do have options in the West open up again, then they should try and play this intelligently to arbitrage between different sources of credit. So while we must continue to call for sort of progressive collective action in the global South, what's more likely to happen in a world where progressive struggles are perhaps weak and disorganized is a sort of new geopolitical economic order centered on China and Gulf states acting in unison. Thank you.
We have 3 more questions that have come up, and I think I should read them out. First of all, Sabrina says, what kind of concrete political solutions are currently proposed in terms of monetary sovereignty for countries of the South as an alternative to the US dollar? For example, the SUR currency proposed by Argentina and Brazil, does it solve the problem? And then there's a second question by Rafael de Mello, which is, I have a broad question. There have been attempts by the global South states to demand a greater voice in international institutions. I'm thinking specifically about the G20, the BRICS Bank, and other such arrangements. Considering that this book brings forth systemic and structural issues, do you believe that these movements from the global South states have been properly addressing the underlying problems? And have they been proposing proper solutions from the perspectives addressed in the book? There's actually 2 more. I think I should read them. I don't think we have time to deal with except short answers, but let me go ahead. Thank you for these wonderful, illuminating presentations. The account of structural subordination is quite compelling, but I'm wondering how it connects to the rise of financialization. How do processes of financialization, open capital markets, impact on interest rates and exchange rates, the predominance of venture capital, of venture and equity funds over banks, affect the ability of countries of the global South to develop effective political responses to the pressures of debt in which they are embroiled? And then lastly, from Alex, in the case of Ecuador, I'm sure something similar happening in Argentina, Bolivia, and Venezuela. When we stopped dealing with the IMF, we had to deal with the foreign debt with China. Is China going to become an imperial power like the United States? There's a couple of other remarks, but I think I just have to stop at this point and let any panelists make, 1 minute remark. Those are big questions.
Yeah, I will just make a few comments. I think the countries, at least in Latin America, are missing out the possibility of using the leverage they have because they are now providing the world, the core countries, with resources that they very much need for their transition through the green economy and stuff. And we are not using that ability to control those resources to renegotiate the conditions of debt payments or debt in itself. And the other question is that I think we need to find out ways to articulate more strongly the solidarity and the struggles in the North and the South in this ratio between debt, which we have to pay, and the resources that we have that people in the North need to transition to a greener economy. I think there the social movements and political movements in the North are not clear about the need to articulate more with our social and political movements to find a way to struggle together for a different way of sorting out these issues. That's it. Thank you very much for the possibility of being here.
Well, I could say something about a single currency project between Argentina and Brazil. I would say that that would not be a good idea because we have to learn from the experience of the Eurozone. The Eurozone has been designed not to increase the monetary sovereignty of individual countries or people's sovereignty, but to serve the goal of global finance. I think that for the global South countries, what they need is first to trade in their own currencies. That means having bilateral or multilateral payment systems. They are not in the need to use US dollar when transacting between themselves. And I think that most global Souths are trying to find ways to trade between themselves without using the US dollar. I think that is a good move. The other thing is that there is a structural technical dependency on the global North. And that is the reason why most countries need to access US dollars. So global South countries could try to have common programs to increase their technological capacities. But a single currency, I think, would be a very bad idea.
Does anybody want to make a comment about China, about the question about China's role?
So yeah, so China's got huge structural power in the global economy because it's such a large net surplus country. So it's an alternative to the United States for many countries. Its engagement is embedded in a language of mutual cooperation. So that does point towards a potential alternative path for countries in post-colonial countries. Conversely, it's an unequal power relationship as occurs in the nature of capitalist relations. The big difference between China and the US is China does not have the overseas networks of military bases and the proven track record of using them. So it comes down to your definition of imperialism, of whether imperialism is vast structural power within capitalism or this added violence of the military and as well the sort of racial embedding of US ideas and culture in the global economy. But it's an alternative for countries that they can use to arbitrate with the US.
Okay, welcome to the second portion of today's panel discussion, focusing on the global South's debt. And the first presentation in the second session is by Basil Oberhauser, who is at the, I have to get it out again, the Global Green Growth Institute. And he will be speaking on managing the balance of payments constraint, dilemmas, and perspectives. He will have more or less 10 minutes. Go ahead, Basil.
Thank you very much. Hello to everyone. I hope you can hear me well. I'm going to share my screen. I have a very short presentation. Very good. Okay. So the starting point of my chapter is the following. In macroeconomic theory, if you look how does mainstream economics and more heterodox approaches, how do they compare with regard to their position on debt? First of all, the mainstream economics basically says with regard to domestic debt, public debt is very bad, so countries should not get indebted. With regard to private debt, there's no real emphasis on private debt. So it's because mainstream economics does not really have a monetary analysis in its models. On external debt, mainstream economics in general suggests or proposes to limit the role of the state to free trade, to free financial flows, the exchange rate, and it assumes like this, we have a stable general equilibrium that will maximize economic outcome and welfare. Heterodox economics is much more critical of this. So first of all, regarding domestic debt, it's very clear if you do monetary analysis of the economy that debt is a necessity for development, is a necessity for any economic activity, and therefore it's also an important aspect for the developmental states, for the state to play an active role to steer economic development. With regard to external debt, however, things change, and the presenters before me, like for example Ndongo, have mentioned this, how important it is to distinguish between domestic debt and external debt. The so-called balance of payments constraint is a very serious obstacle to development, because whereas you can better control debt that you issue in your own currency, foreign currency is out of your control as a country. And if you do not respect this constraint, that will lead to debt crisis, to devaluation, to inflation. And that means this external constraint, the balance of payments constraint, is a very serious obstacle to economic development. And that also means that the developmental state faces a serious constraint. And that is even worse by the threat of capital flight. So even if an active government who wants to pursue an ambitious development strategy threatens or announces to do a certain policy action, like for example, increasing tax, then capital starts fleeing out of the country, and that might even bring a debt crisis and devaluation of the exchange rate much sooner. So that means, unfortunately, because of the external constraint, because of the problem of external debt, we can observe a certain convergence of the heterodox economic approach to the position of mainstream economics, because we have to admit, to avoid currency and debt crisis, the government of a country has to apply some form of austerity. It cannot maximize its growth rate that it would otherwise, because high economic growth will lead to usually will lead to higher trade deficits, will increase foreign debt. So you need to control foreign debt, and therefore you cannot grow at the speed that you like. That means some form of austerity. And what does that mean? And is there a way to get out of this dilemma of the external constraint? What I look at in my chapter to this book is first, as we have heard before, one important feature of current global imperialism is that not all currencies are equal. And for countries in the global south, which have subordinate currencies, that means the way that the international monetary system is created, is organized today, all international payments take place twice. They are paid once in domestic currency and they are paid once in foreign currency. Let us look at this for a short moment. And to make it simple and in the interest of the limited time, I will refer to a few examples that are very urgent at this moment. So Zambia, we know, was the first country in the global south to default in the course of the COVID pandemic. And currently, Zambia is using 30% of its budget for external debt service. And that amounts to its local currency of kwacha, which is 51 billion. Ghana also defaulted recently on part of its foreign debt. Currently, it's using 30% of its budget for interest payment, and of this debt, about 58% is foreign debt. Then another example that is very urgent now and considers the whole issue from a partially different perspective. The case of Ethiopia, you could also mention many other examples in this regard. It has a very large trade deficit that amounts to about 13 billion USD. And currently the country has foreign exchange reserves that are able to cover about 3 weeks of import. So you see the situation is pretty much on edge in this country. Another example, Kenya is currently using about 16% of its budget for external debt service. And just recently, the government stopped paying its government employees. Even some regional government employees have not been paid their salaries since beginning of this year. And the government says, we cannot pay the employees because we have to service the debt. So they say we have to choose between not paying, between paying the employees and going into sovereign debt crisis, or we keep servicing the debt. And they are currently deciding in favor of servicing the debt. Now, my question that I would like to ask you is, where does the money that is paid in domestic currency go? So you see in these 4 examples, when Zambia services its foreign debt, it pays in kwacha. Ghana pays in cedi. Ethiopia pays for its excess imports in Ethiopian birr, and Kenya services its debt in Kenyan shilling. But we all know that the receivers of these transactions, of these payments, they receive the payments in foreign currency, usually in dollar, maybe in euro, but usually in dollar. So if the payments are made in domestic currency, but the foreign receivers receive it in foreign currency, where does this money paid in domestic currency go? And the answer is, it is destroyed by the banking system. And what does that mean? First, countries, when they have to pay for the external obligations, they require foreign currency, and that means they need to earn exports, which give them the foreign currency that they can use to pay for the for external obligations. So that means to make this payment in foreign currency, they pay in form of exports. That is the first payment. And the second payment is, since the international payments by the domestic residents of a country are made in their domestic currency, that currency goes to the banking system, and from there it has to be settled in foreign exchange. So the domestic currency being paid by the domestic residents is cancelled out of the bookkeeping, of the balance sheets. And that means this domestic currency is not able anymore to circulate in the domestic economy. So if we pay for external obligations, I pay in Kenyan shilling, for example, and it goes to the banking system and is lost there, it's destroyed by the banking system, then that money is missing in the domestic economy. And demand in the domestic economy is shrinking, and therefore output in the domestic economy is going to shrink. And that is the second payment, you understand? So these countries who are in deficit, who have to service foreign debt, they pay by earning the foreign exchange first to make the payment, and they pay a second time by sacrificing a part of their national output. And now, what I would like to have a brief look at, and to be very quick, is how can countries get out of this trap, and how can a potential reform contribute to not only stabilize domestic output, but also to avoid future debt crisis. And the advantage of this proposal that has been developed by Keynes first, by Schumacher, and then essentially also let's say completed by the economist Bernard Schmidt, is a monetary reform which can be applied by one country unilaterally. And the first idea of this reform is the following: instead of destroying the payment that the country makes in domestic currency by giving it over to the banking system where it's deleted out of the books, out of the balance sheet, this domestic currency should be recycled. It should be spent in the domestic economy. So let's say the example that we heard before. Kenya says they have to service, the government says they have to service foreign debt, therefore they cannot pay their employees. How is that the case? If they sacrifice, if they pay in domestic currency, the debt in foreign currency will be the same. So why do they spend the domestic currency that helps nothing in reducing the debt in foreign currency? So instead of doing this, they could use this domestic currency to actually pay the employees and while at the same time not affecting the foreign debt, because that debt remains the same. So that means we have essentially solved the problem of austerity that deficit country encounter because they make a double payment in the foreign obligations. Let us take this one step further. The second idea is, instead of spending, now we've decided we spend this domestic currency in the domestic economy rather than destroying it, but instead of spending it for consumption, we spend it for productive investment, because this productive investment will provide us with the new assets that actually represent the loss, the gap that we have in the external balance. So, for example, if we face a trade deficit and we have to pay this deficit, and as I said before, in the case of Ethiopia, this is paid twice. It's one paid in domestic currency and once paid in foreign currency. If we use the domestic currency to build assets, we build the assets that we can either export, or we can export in real goods, or we can export the assets in form of securities. And at the same time, such real investment strengthens export capacity of the country. That means this investment creates the assets that we have, that we need to close the gap between exports and imports. And in practical implementation, this means that a new institution that a country can build takes responsibility to settle all international payments of the country, and it makes sure that domestic currency payments are not destroyed. That leads us to the advantage that we have restored external balance, foreign debt stops from accumulating, and second, the developmental state is back like this. It gets the space again to implement ambitious domestic development strategy and can assume an important role in domestic economy again. That is, I'm already at my end, and I stop here and hand back to Paul. Thank you very much.
Thank you very much, Basil. We would like to have now the opportunity for the Rosa Luxemburg Stiftung to make an introduction to the second session. And I'd like, therefore, to call upon Arif to Zushgar to make a presentation. I'm sorry about the name.
Yeah, no problem. Rüzgar is my name, Arif Rüzgar. And I want to say thank you for the opportunity that we can introduce ourselves, the Rosa Luxemburg Foundation. I will say a few words about myself. I should have introduced the foundation before Basil's presentation, but it's also okay to have it after that, because it is very close related to things you said. My name is Arif Rüzgar, and I'm the program director for economics and trade at the Rosa Luxemburg Foundation, based in Brussels. Yeah, although we have a lot of foreign offices all over the world, and the reason why I want to introduce the foundation is that I want to invite you to contact the different offices we have all around the world, and we have also people from all around the world. So you can contact every time you have opinions or events about Global South. That's the main point of the foundation's foreign offices, to have a view, to have analysis, and also policy proposals for how to shape the global economy so that development is possible. So a few words about the foundation now. The Rosa Luxemburg Foundation is an internationally active left-wing non-profit organization for political education, and is affiliated with the German party Die Linke. the Left Party in Germany. The foundation is dedicated to the study of social, political, and economic processes and developments worldwide. In cooperation with the progressive organizations from all parts of the world, we work for democratic and social participation, also empowerment of disadvantaged groups, and alternative economic and social development. So in one of the main points of my work in Brussels, together with different offices worldwide, are the deal trades, which are going on faster than we had it in the last 10, 20 years. And I think we have also to deal with economic principles underlying the trade negotiations worldwide, because I see, my opinion is that the mainstream economic theory is a strong theory which leads, especially the Ricardian theory of foreign policy, foreign international trade, is leading the global organizations. And we talked about sovereignty, and I think the backdoor of just pushing through the neoliberal principles is also our trade deals, and we are trying to oppose the trade deal, how they are shaped right now. And insofar, I would invite you to contact, if you have events or if you have papers, contact with different offices in the different regions worldwide. I would also like to express my sincere thanks to the organizers and my dear colleague Ndongo for publishing the very important book and very interesting topics, and also the authors. In addition, a big thank to the translators for making this possible, for getting together people from all around the world. It wouldn't be possible if we hadn't the opportunity to invite you, and thank you again. Thank you, Paul, for moderating all the sessions, and maybe I can talk a little bit later about different topics and raise questions and about the feasibility of economic and financial policy. Thank you.
Thank you very much, Arif. Our next presentation will be by Christina Lazaridis. She will be talking on refusing to improve sovereign debt repayment difficulties and the political economy of inertia in UNCTAD 1964 to 79. Go ahead, Christina.
Thank you, Paul. I just want to check that I'm audible and that my presentation is visible.
Yes, yes.
Okay, that's great. So it's firstly my turn to extend a very warm thanks and note of gratitude to the Rosa Luxemburg Foundation, to everybody at the OU, and especially to Ndongo Sambasila, Jenny and Andres for all their work in putting this together. And a very warm congratulations for the publication. It's a great achievement at bringing so many contributions together. I want to briefly talk about my chapter in the book. The title of my chapter is Refusing to Improve. It's about the political economy of various attempts to improve how sovereign debt negotiations and restructurings would take place prior to the 1980s debt crisis. I've really focused on UNCTAD as a sort of pinnacle of the efforts of developing countries to actually gain access to negotiation space. And some of the points that have already been mentioned in the previous panel really ring true to this. I'm particularly thinking of a point by Charles Abougre on how the way that negotiations take place are very much sort of the product of power and power relations. And I think my chapter really sort of illuminates a certain aspect of that. So what's normally been talked about and why this is relevant for today, even though this might seem like a very sort of arcane or historical chapter, is because what we talk about when we talk about a sort of sovereign debt architecture, we're really talking about a sort of a patchwork of norms and procedures that have developed in an ad hoc way over different over decades to result in this framework that is largely well developed by creditors to suit creditor-driven interests, and that's something that we've all kind of recognised. The way that restructuring takes place and the empirical work that's been done recently really highlights some of those features, both the increased frequency, the sort of too little, too late phenomenon, the increased litigation, and the sort of accompanying conditionality that leads to inequality, poverty, and doesn't resolve the debt problem anyhow. So my chapter really tries to go through all of the various, tries to really sort of anchor the point about why we don't have a better solution at resolving sovereign debt repayment difficulties in the international space by looking at the different attempts that were made and how they were repeatedly voted down and blocked by creditor countries. So in a bit of context, and I'm only saying this because a lot of the time the discussion starts with the 1980s, 1982, as a sort of starting point for the previous sort of era. And what I really want to highlight is that really from the post-war, the rising international capital flows and the form of those capital flows both led to the general deterioration of repayment capacity. It was accompanied by general deterioration of repayment capacity in developing countries. And that already from the 60s, you had the growing repayment difficulty surface and increasing concerns about changing the terms of those flows. And this is a sort of an extended introduction, just because most of my talk is really centered around this table, which really spans what I've seen as key milestones and episodes in this, let's say, debate. Mainly a political debate, like I've mentioned in UNCTAD's third committee and also in the Trade and Development Board negotiation space. I've sort of traced each UNCTAD conference from the first one to the one just on the eve of the 1980s debt crisis, and try to follow what were the different positions that were put forward by different groups of countries, whether sort of organized debtor groups or other types of grouping. So the main developing country group is the group of 77. And then as that kind of forum splinters into other parallel negotiating spaces, which I'll go on into, again, you have different groupings putting forward their points of view. So from the 1960s, there were numerous proposals tabled, both about alleviating the terms of repayment and sort of linking the volume of flows to an actual repayment capacity. And what repayment capacity meant was not clear. There was no precise understanding, technical understanding of how repayment capacity would be measured. But there was an understanding that the volume had to be linked to it. So some of the proposals that were agreed without dissent agreed to that general notion, a notion that I've generally worked on as being the sort of antecedent notion to what sustainability is understood as today. But given the rise of repayment difficulties, there were numerous proposals that involved developing country proposing further cooperation between debtors and creditors. So for debtors to have the initiative to propose reschedule when they wanted to either extend maturities, to have caps on interest rates, to have repayment possibilities in local currency, different schemes with which interest costs could be reduced, largely because of the hardening of development flows throughout the 60s, all of which were refused. And where available, that information is provided in the chapter, the abstentions and against are the usual creditor country suspects. Those efforts continue into the second UNCTAD conference, with a notable change being not just proposals to improve the terms of how international loans are being provided on a bilateral and official sort of flow basis, but also on the need of establishing criteria. And there's different types of criteria that's being talked about. One type of criteria is that there's a big concern that the way restructuring is taking place is being done to suit specific political interests, and there's no common agreed framework on how that should take place. So there are numerous examples being mentioned and developing countries asking for established criteria on debt restructuring that should largely follow pre-agreed principles and rules. And just in sort of like a point of hindsight, for those who have followed the debate in the sort of 2000s onwards, the reason why the General Assembly principles and the UNCTAD principles being such a great success is precisely because of how long, from 2015 onwards, was precisely because of how long-standing effort the idea and the need to establish guidelines for rescheduling were from this period. So there's a general urgency that's put on the table by developing countries to both study the sort of root of the debt problems and to establish these general criteria for rescheduling. In UNCTAD 3 in Santiago, hosted by Salvador Allende, again, to the usual problems of inadequate terms of the loans and insufficient volume of resources, there's a lot of emphasis played on these procedural aspects. So there's a need for kind of established rules. There's also a need for an economic analysis that reflects a common understanding of the problem. And so you start having these very quite entrenched positions between debtors and creditors about the nature of the problem and the different policy conclusions that flow from them forming in these ways that we are now very familiar with, but you see the roots of that in this period. So the idea of a short-run problem that's associated with a case-by-case approach and a sense of an imminent default, which will be dealt with the IMF, and the sort of long-run problem, which creditors see as being dealt with and it can be dealt with through adjustment, and debtor countries really countering that division of analysis into short-run and long-run, and really putting forward a sense of a common, that developing countries are facing are being affected by common problems on the international level that's bringing debt problems across them. So in the 1970s, you also have the sort of other international efforts which are really important in terms of coalescing calls for greater social justice on the international arena, condemnation of neo-colonialism. I'm talking about the NIO and other efforts equivalently, and increasingly the debt problem being formed and phrased in terms of a North-South dialogue, a framing which developing countries are increasingly abhorrent, sort of very vocally against, forming and phrasing the debt problem in those terms. Instead, there's a much greater effort from the creditor side in formulating the problem of debt as one of domestic adjustment, domestic mismanagement, and steering clear from any international sort of structural issues that might be common across those countries. So you kind of get a rigidity in the explanations that are coming through. So after the mid-70s, you have a splintering of the negotiating space, both because UNCTAD, the sort of inertia in UNCTAD becomes so great. It becomes a really just sort of hothouse, debating house. Its negotiating power sort of declines. There's just stalling on all topics. And I've really just focused on the debt topic, but there's a number of issues being talked about. And so you get these deferrals into these subgroups and negotiating spaces, which really are just kicking the can down the road, because there's no agreement on what to do. So some of those spaces are, so even though you might have a sort of nominal agreement on the idea of establishing a machinery inside UNCTAD to deal with the sort of structural way to address debt repayment difficulties, when it comes to the actual clarification of how that internal machinery would work, it's deferred to various governmental group of experts, which again sort of just play out the same divided opinions between developing and developed countries. I just want to really just kind of get to the eve here without taking up more time. The sort of summary point is you get the splintering of the negotiations into these side groups, UNCTAD losing its force as a kind of means to actually achieve the changes and the promises that had been hoped for. You get a lot of sort of empty promises and no real consensus on how to take things forward, despite sort of governmental groups of experts proposing things which are actually passed, but no progress is really done on them. Yeah, and so I'll just conclude with a few final points. One thing that might seem, so one of the conclusions is that there were numerous attempts by developing countries in all sorts of different forums to basically deter the crisis that happened in the 1980s. Numerous proposals were sort of mild. Some of them were great and structural, but on all levels, creditor countries refused to acknowledge the existence of a generalized problem and insisted on those problems being case by case. And that was happening in the public negotiating arena. At the same time, though, because the exposure of Western banks to developing country debt was growing, posing financial instability problems, particularly to the US. Behind the scenes, so outside of that negotiating public sort of political spotlight, what becomes apparent is that creditor countries were vastly, underprepared, but also grossly concerned about the possibility of a generalized problem. And in that context, they were actually developing techniques of lending in a way of establishing criteria and sort of debt repayment capacity techniques in order to understand whether through early warning models or otherwise, whether debt repayment problems were on the horizon. So you have this kind of public condemnation and sort of refusal to make any progress in the public domain. But outside of that, a kind of recognition that those problems were mounting and that general problems were there. So I'll leave it there, and I look forward to the discussion. And thank you very much again.
Thank you very much, Christina. And our next presenter will be Fumi Arinwa from Temple University, who will be speaking on colonial hangover in global financial markets, Eurobonds, China, and African debt. Go ahead, Fumi.
Okay, please let me know if you can't hear me. First of all, I want to say it's a pleasure to be here today. I wanted to thank the Rosa Luxemburg Foundation, OU Press, for organizing this session, and also extend a real appreciation to Ndongo Sambasila for putting together such an important book. I come to this topic primarily as a lawyer, legal scholar, and anthropologist, and my remarks are actually based on my earlier book. I'm going to talk a lot about colonial hangover today, and my remarks follow pretty closely from some of the points made by Charles Agugre and Christina Lascarides. So I'm going to talk about three things today. First of all, I want to talk about recurrent African debt defaults or debt problems with repaying debt and development. And then I want to talk about colonial hangover in global and local institutions. And if any time remains, I want to talk a bit about future possibilities. So I think it's important to, as an anthropologist, I like to contextualize the current debates about debt, both in terms of time and place. So I think, I think a number of people had mentioned that in November 2020, Zambia failed to make an interest payment on $1 billion of Eurobonds that were maturing in 2024. And it became the first African country to default on its obligations during the current debt, some people call debt crisis that African countries are facing. And this was in the aftermath of the COVID-19 pandemic, which obviously caused a lot of global financial distress, but particular distress in many countries in Africa. Zambia was followed by Mali in early 2022 and Ghana late last year, with the possibility that some additional defaults may follow. Notably, however, as I think was mentioned by an earlier speaker, public level debt levels in Africa today are well below levels during the debt crisis of the 1980s and 90s, and notably well below that of other countries. Zambia, notably, now it's 2023, we're 2.5 years after Zambia's default, they have yet to restructure their debt under the G20 Common Framework. And notably, part of that is that some of the difficulties in the framework that was established during the era of independence. And that has an important historical context that we need to think about a bit, and I'm going to talk about a bit. So notably, this is not the first African debt crisis. It reflects, however, continuing patterns of what I refer to as external determination in dealing with what are thought to be African debt crisis. And I think there is a debt crisis, but I think that crisis has a lot to do with Africa's external relations, I think, as other speakers have mentioned. And I think it's important to look back to the 1980s debt crisis, when structural adjustment programs were a dominant policy response to deal with highly indebted countries in Africa and Latin America. So if countries at that point needed financial assistance from the IMF and World Bank, they had to meet certain conditionality requirements in order to have their loans approved. These structural adjustment programs were implemented by the IMF and World Bank in ways that led people at the time to call them the new overlords of Africa, and basically positioning them as having taken over. They're sort of the new forms of colonialism. And the new powers are not the old colonial masters, as was mentioned in the New York Times article. Now the external superpowers are the IMF and the World Bank. These institutions, founded at Bretton Woods to serve the needs of the industrialized world, have become the overlords of Africa in the 1990s. So I think it's important to think about how African countries are positioned vis-a-vis external power relationships, and the sources of those relationships may change over time. And I think if we look at the Zambia debt default, part of what we're looking at is changes in the characteristics of who the lenders are to many African countries. I'm going to come back to that point, but I want to first of all note that debts typically incurred in Africa are often part of development strategies that are actually intended to reduce poverty. And as part of this, I think it's important to discuss that Africa today is increasingly a global center of poverty. World Bank projections suggest that poverty will be an increasingly African phenomenon. By 2030, 90% of the world's poor will be in Africa. As was noted by an earlier speaker, 30% of Zambia's budget is going to interest payments. That's 30% that could be used for internal needs related to healthcare, schooling and education, and other really critically important development needs. And we're in a situation where the number of people in poverty in African countries is increasing, despite the fact that poverty rates are decreasing. And that has a lot to do with demographics. African countries have the youngest populations in the world, with median ages under 20 years old. So governments have used, sovereign debt does have the potential to be used to meet critical development needs. However, one of the things we're seeing in Zambia and other former colonies, not only in Africa, but I'm going to focus on Africa today, they've experienced recurrent cycles of debt. And these cycles involve incurring debt that then becomes unmanageable due to often external and internal factors, and leading to a need for debt relief. So unsustainable debt followed by a need for debt relief is not uniquely African. We have added complexity today because of the changing characteristics of lenders to many African countries. We have new sources of financing that have really emerged in a significant way in the last 20 years, particularly from Eurobond creditors and China. That means that debt restructuring today is increasingly complex. So debtors may have to negotiate through different interrelated channels, depending on the nature of debt, including multilaterals, financial institutions, the Paris Club, London Club, creditor committees for private lenders, and China. Now, today, often China is the focus of discussions of debt distress in Africa. However, I think it's really, and one thing my article does is note that Eurobond lending in African countries is on a similar scale to debt owed to China. The BU Global Development Center, their debt documentation suggests that China between 2000 and 2020 gave $159 billion in loans to African countries. Between 2006 and August 2021, 21 African countries sold Eurobonds worth $155 billion on international bond markets, issuing in 2021 alone, $11.8 billion in sovereign Eurobond debt was issued alone. So these new creditors reflect important trends. They reflect the fact that African countries have increasingly have greater access to international financial markets, some for the first time. However, they also reflect potentially problematic patterns in that interest costs for many African countries are exploding. So a significant portion of budgets in many African countries are being devoted to interest payments on debt. Notably, it's also important to note some of the holders of the Eurobond debt Eurobond debt is issued on private market terms, so it's a much higher interest rate. Typically in prior debt crises, a lot of multilateral and bilateral lenders were the primary lenders. Interest rates were lower. Eurobond debt is issued at very high interest rates, especially since African debt is often considered high yield debt because it's considered riskier. And the holders include large global financial institutions, including BlackRock, which was mentioned before, which in 2022 was the largest known holder of Zambian Eurobond debt. Now, the role of BlackRock highlights the role of fund investors generally, who've assembled vast resources that search globally for opportunities for profit and arbitrage, including through secondary market trading strategies relating to sovereign debt. And Zambia was actually, there's a really interesting case in the UK, the Donegal legal case that involved secondary market purchase of Zambian debt, where Zambia was forced to repay the debt, despite the fact that somehow their foreign sovereign immunity was mysteriously waived as part of the transaction. So investment funds now. Okay.
The translator asked please to slow down a little bit.
Okay, I'll slow down. So global assets under management by funds has increased to 145.4 trillion, or is projected to increase to 145.4 trillion in 2025. So these kinds of lenders are really important part of the Eurobond market, and they reflect vast resources that are controlled by small groups of private actors, not governmental actors, that are often supported by their governments from a policy perspective. So in the digital era, we have not only those forms of concentrated capital, we also have significant concentration in the IT sector that exacerbates possibilities of control today by a narrow range of private actors. Notably, between 2012 and 2020, African external debt stocks increased by close to 85%, and public and publicly guaranteed debt increased by close to 118%. Now, this increased access was part of a number of factors that have been discussed by prior speakers, including low debt levels because of earlier debt relief, strong economic growth, as well as zero interest rate policies in much of the developed world that led fund investors like BlackRock to search the world, to scour the world for opportunities for arbitrage and profit. And I think one of the things I argue in my chapter is that what we're looking at is a form of governance arbitrage. So that brings me to talk about, and notably the Eurobond debt is typically denominated in dollars mostly, and in some cases euros, which makes management challenging for many African countries. So the structures that we see globally relating to debt restructuring is a product of colonial hangover that has an impact on both global and local institutions. And a key element of this colonial hangover is power relationships that were established under conditions of colonialism that continue to the present day. And I think Christina Laskarides notes that the debates about restructuring today relate back in an important way to debates at the dawn of independence about state succession. And those in turn actually reflect debates at the time of World War II about succession to World War I, about succession to debts. I'm not going to go into that in detail, but notably, developing countries that were trying to change the rules of the old international economic order to have some kind of formal debt restructuring mechanism, they essentially lost that argument. As a result, today we have ad hoc debt restructuring that continues to reflect the power dynamics of colonialism and the relative powerlessness of countries in Africa, as well as other developing countries. And this is reflected in a couple of different ways. In what the economic institutions that were established in 1944 at Bretton Woods continue to exclude countries in Africa and other developing countries from having effective power within those frameworks. So we also have unequal relationships of power that emerged, that were evident during colonialism, that continue today. So these are structural limitations, these structural contexts of inequality and exclusion. Within these contexts, external capital has long played a role in financing African development. So it's important to look at what are the patterns and internal arrangements and arrangements that govern those external financing, that external financing that's been provided.
Couple more minutes for me.
Okay, I'm gonna try to stop slowly and tie up. So existing global models used in African context, from the industrial era to the digital era, have been in too many cases based on a model of plunder and extraction of raw materials and funds in the past, and increasingly today, things like data and information. This has been based on exploitation and extraction. It's contributed to capacity deficits, and by definition is not sustainable. These extractive patterns are a key factor in financing needs. So the thing to note about Zambia, which is one of the focuses of my chapter, is that Zambia, while it's had to incur debt, has also seen massive outflows in the form of IFFs that are mostly likely related to large mining companies that dominate their international trade. So we have extractive models, but we also have, I want to just note, jurisdictional arbitrage, because we have some problems of incentives. If we look at the incentives of internal actors in many countries are not restrained internally legally. That's why when Eurobond lenders issue debt to countries like Zambia, they make sure that debt is governed by either English or New York law, which means that they go to some place where they can get their debt obligations enforced. In contrast, people within many countries have limited ability to actually enforce debt, even if it's incurred involving fraud or corruption. And the fraud or corruption is not just internal parties. The Mozambique debt corruption case shows that employees at Credit Suisse conspired with people internally in Mozambique to undertake loans that Mozambique is fighting to not be obligated to repay. So the current system, I think it's important to note, creates bad incentives for both lenders and debtors. And also from the lender perspective, especially if we look at secondary market transactions, may create opportunities for arbitrage of differences in governance regimes because of the lack of internal constraint, the lack of internal ability to get recourse for bad debt, and the fact that the external actors choose external legal regimes to try to enforce debt obligations. So future obligations, I think it's important to shut down opportunities for jurisdictional arbitrage and create internal and external incentives so that we don't have a situation where we have transgenerational poverty, where people are being forced in later generations to repay debt obligations that really weren't appropriately monitored by lenders and that might have been incurred internally with little constraints on those incurring debt. I'm going to stop there. Thank you.
Thank you very much, Funmi. And now we're going to turn to two discussants for this session. One is James Gaffey, who is at Royal University in Chicago. Go ahead, James.
Thank you so much, Paul. I have three sets of comments. This has already been such a rich discussion, such great contributors to this book, and congratulations to all of them for such a book. I have three sets of comments, some general comments, and then two sets of, since this panel was set up as solutions, two sets of solutions I think that come together in this book. So first, as I said, this is a really superb book and superb authors who really wrote very good chapters. I thought that the way that the book comes together very cohesively and also in terms of its readability and accessibility is very laudable. It makes very important interventions in these long-standing discussions about sovereign debt. And as we just heard from Funmi's chapter, the current crisis is part of a much longer and really contested history, as Christina was showing. I think that one of the big takeaways from this book is quite clear that overall, the creditors are very happy with minimalist reforms, just enough to contain pressure for more radical reforms, while they reap massive profits. And so we have to see the kinds of initiatives that they were talking about last week in Washington at the spring meetings of the bank and IMF, like the improving the common framework or the new debt roundtable brought to bring China in, as joining the long line of efforts, as Christina's chapter shows, of minimalist reforms that kick the can down the road. They do not do nearly enough to challenge or address the root problems in the unequal governance of the global financial system, if there is such a system. The assumption of all these reforms is that this system is here to stay. It's not going anywhere. And just to add to what Fumi was saying, for example, Africa's 55 countries are really underrepresented in the International Monetary Fund, where they have a meager 6.01 voting rights. And we know at the helm of that system at the IMF is the World Bank, is the United States, that has over 17% of the voting share. And since the way that fundamental reforms of the system in the IMF are done is by an 85% margin, the US has an effective veto over any fundamental reforms of the system, including in what they're going to be discussing this year, quota reform of the IMF. We're not even talking about the Paris Club that, of course, is very well represented in the IMF and has a majority of the special drawing rights. And we know their approval is really significant as a precondition for renegotiating debt. So in any event, the second general comment is the comparative strengths of the book are really great. I like, especially in part 1 of the book, the way that it looks at various African economies, but also at Latin America, and in particular, Argentina. I thought that the chapter on Sudan was superb, sort of foreshadowing what we have seen recently in Sudan. And there are a couple of countries like Sudan and Zimbabwe we often don't talk about in the context of sovereign debt, and they're pretty unique. And so it was really great to see Sudan here in this book. Also, I like the interdisciplinary strengths in the book. Various strands of economics, and not the types of economics that comes from the World Bank or the IMF, anthropologists, as we've seen with that chapter that Fumi just talked about. And generally, I think that the fact that the book makes some important arguments that are not typically in sort of mainstream discussions about sovereign debt, in particular, the fact that one of the key arguments is that sovereign debt in many countries of the global south is a legacy of imperialism that has origins in colonialism, dependence on exports of primary and low-wage-based products. That kind of argument is not the kind of argument that I'm sure was featuring anywhere near in the discussions last week at the spring meetings of the bank and the IMF. Also, as we already had this morning, the book shows sovereign debt is not merely a domestic issue, but one that has roots in the global economic system as well. So to my second set of comments, with regards to the two sets of major types of reforms that the book proposes, the various chapters in the book proposes. And here, I had more extensive comments, but I just want to be very brief. So I just want to divide those reforms into two. It's not a very neat division. I'm sure the authors would argue that I mischaracterized them. But just to simplify, I would say that the reforms within the system and then reforms outside the system. So for example, I would say that with regard to reforms within the system, I really like the examples given in the two Argentina chapters at the beginning of the book, and how under President Kirchner, major debt restructuring, especially from 2005 and 2010, resulted in substantially dropping Argentina's debt, including Argentina's early repayment of $9.1 billion to the IMF. But that was just setting the scene, because then after that, after the 2007-2009 financial crisis, a change in government, the vulture funds coming in to cash in, troubles started all over again in Argentina. And therefore, the initial set of reforms in terms of debt repayments did not really make a substantial dent in the debt situation in Argentina. In The second chapter, I like the discussion a lot about how to think about debt sustainability, and I know one of my
Me
co-commentators.
gusta cómo el segundo capítulo piensa la cuestión de la sostenibilidad de la deuda y me gusta que la lección principal
as a question of generating an adequate cash flow between a country and its creditors, but thinking of it in terms of the extractive nature of the kind of debt sustainability analysis that the IMF conducts, putting extreme pressure on labor and nature, and of course, benefiting the creditors at the expense of domestic constituencies who have to face the risks and negative consequences of borrowing. Milan Rivi's chapter examines why there is no functional, comprehensive international mechanism for debt restructuring, and discusses at length one of the proposals by 10 civil society groups made in 2019 to guide sovereign debt restructuring. This recommends the creation of an independent body under the auspices of the United Nations. It sort of dovetails very well with the proposal made by the panel set up by the UN Secretary General and headed by Joseph Stiglitz after the 2007-2009 financial crisis. But that chapter also discusses other reforms that I would characterize as within the system, such as audits of public debt with public participation, declaration of nullity of public debts. We already had Basil's chapter this morning, sort of adopting a very Keynesian solution to the debt crisis. So that's sort of one set of reforms. And so before I end, the more systemic reforms, the more sort of systemic reforms proposed in the book, in some of the chapters in the book. This is in particular, I would say in Dongo's chapter, but also in some of the other chapters. Here, the claim is that change is required in the productive structures of a lot of the indebted countries that would also require changing the complex set of social relations between classes and factions that make possible the accumulation of capital at the national level. And listening to a lot of the conversations this morning, we can't eliminate from this discussion the role of domestic elites who are very well tied to global capital. And so in terms of thinking about the solutions at this level, I think it's really important to sort of think of what some are calling the transnational capitalist class. It's not that we have developing countries on this hand and then sort of developed countries representing their creditors on the other hand. These are really well integrated systems of extraction of wealth from these countries. In any event, some of the other proposals, new ways of obtaining dollars beyond foreign direct investment and debt, that might include nationalization of strategic resources, creation of public enterprises in key sectors, redirecting public and private investment specific export sectors, strengthening control in foreign trade operations and pursuing agreements with other countries where trade could be conducted in another currency. And in fact, this is really a very significant proposal.
About another minute or so.
Okay, yes, I'm just about to end. The claim here in particular in Dongo's chapter, sort of inspired by modern monetary theory, ecological economics, and dependency theory, is that these highly indebted countries are not merely suffering a currency shortage, but rather it's primarily because they are trading in foreign currencies they don't have any control over. So this is sort of an argument for monetary sovereignty. And the last thing I'll just say here is that Dongo gives the example of countries like Japan, which have issue debt in their own currency, and which carry tons of debt, even more debt than many of the indebted countries, for example, in sub-Saharan Africa. And he argues from this perspective, the roots of the cyclical problem is sort of the problem of their lack of monetary sovereignty and having to pay off their borrow and then pay off in foreign currency. And finally, citing Samir Amin and Harry Magdoff, he argues in favor of these countries taking the charge in their own hands and sort of not leaving this to other countries or other interests to do their bidding for them. So thank you very much.
Thank you, James. And actually, you answered in part. There was a question about 45 minutes ago on the chat, which says, I want to ask if there are if we are just discussing the problem or improving it too. And you're actually answered the question that we're doing both. We're analyzing and we're also trying to improve. So the next and final discussant is Karina Patricio Ferreira Lima from the University of Leeds. Go ahead, Karina.
Thanks, Paul. Good afternoon, everyone, including the panelists and our distinguished participants as well in audience. It's an honor to be here to serve as discussant for this insightful panel. And I also extend my congratulations to Sam Basila for editing this timely and also thought-provoking book, and for organizing this event, and also, of course, the Rosa Luxemburg Foundation. Well, stakes are now quite high after James' discussion. I'll do my best to meet the high quality requirements while also trying to be as brief as possible. And I'll focus my comments on the panelists' articles / chapters only. In terms of, so I'll focus a little bit on all of them. So Ariwa, in her work, which I found very interesting, especially in terms of discussion in the Zambian case and connecting that with broader issues around sovereign debt governance, I think she provides a very interesting account of the interlinkages between colonialism and sovereign debt. I think she also skillfully highlights the changing landscape of sovereign debt markets, especially in low-income countries, because there is this huge shift from official creditors to now a diversified creditor community, including bondholders. She highlights the role of BlackRock in that specific case, but also bondholders in general, hedge funds, investment funds. We have, in particular, she highlights the emerging role of China as a significant bilateral creditor. So basically, there is a changing landscape that includes now low-income countries after the debt relief initiatives that were held during the late 1990s, early 2000s. And the Zambian case, which she discusses in detail, serves as a prime example of how creditor diversification poses challenges to debt restructuring. Another thing she emphasizes is that I found very interesting is the need for development policy to address the cyclical pressure on the country's balance of payments that result from reliance on commodity exports and also on the foreign ownership of assets, which is which is a significant pressure in the case of Zambia because of the reliance on copper and also foreign ownership of copper mines and so on. And she calls for a structure, we think, of innovative legal and policy approaches that are grounded in the local. And I'll get back to this point in a minute, because grounded in the local is it's a very interesting suggestion that I think connects with other chapters as well. So I'll get back to this in a second. In terms of Christina's work, she examines the role of economic analysis in debt distress debates, and I think she shows in a very clear and insightful way how actors embedded different visions of economic knowledge to frame policy issues. So her chapter demonstrates how the politics of economics and the mediation of economic knowledge in an equal power context played a vital role in shaping the creditor and debtor positions in sovereign debt discussions. And I think her crucial contribution, not only in this chapter, but her research in general that I've been following and I follow with huge interest, is to trace political discussions on debt at UNCTAD conferences and also the intergovernmental expert groups that resulted from those conversations, and providing a compelling account of how the current debates on debt crisis resolution echo those held from UNCTAD 1 to 5, right? So here the historical ground and basically the archives she's looking at also, they echo what we are living now. It's a sort of, in a sort of very interesting way, because the debates, it shows that the debates are cyclical and they haven't been solved at all. And I'll get back to that because there are many similarities. The chapter kind of focuses on that. And this is important. And also I think the debate on the differences is important. So I'll get back to this also in a second. But basically her analysis reviews the historical divide between debtor countries, advocating for a structural understanding of sovereign debt issues and a structural solution to sovereign debt crisis, and creditor countries insisting on case-by-case negotiations, which then later on also included lobby groups, industry groups that also advocated for case-by-case negotiations. But anyway, those industry groups were also based on developed countries. But here we have this strong opposition in terms of cognitive opposition between understanding the problem from a structural point of view and looking at it from a kind of individualized perspective, which has implications in terms of how you understand sovereign debt and the way you intend to address sovereign debt problems. And finally, Basil's work, which I learned a lot from, it kind of delves into the alternatives for overcoming balance of payments constraints and kind of explores the potential for a single country to unilaterally implement a reform of international payments. In the reform, he suggests, would enable the country to stabilize the current account, avoid foreign debt accumulation, and also support domestic development strategies. As he notes here, from the perspective of all countries that do not issue the world's top currency, in this case the dollar, international means of exchange is kind of exogenously limited, right? Because the countries do not control the production or issuance of that currency, so it's exogenously constrained. And foreign debt is a result of the need to compensate for the losses of capital flight in various ways, and still be able to pay for imports and other expenses. So foreign debt has a sort of structural cause. And from a balance of payments perspective, developmental policies rely on imports of capital goods and need to take into account the need for current account deficits for an extended period, because if you are to import goods to produce, to kind of develop your productive capacity, you have to use foreign currency to purchase those goods. And the problem here is that, well, as he discusses, that heterodox economics, mostly based on post-Keynesian and classical foundations, tends to suggest that to manage limited foreign currency resources, you have to control trade flows and to moderate the external constraint, and also capital controls should have a role both in terms of
un rôle pour s'assurer que
1 minute or
Il a
one
utilisé
more minute.
des investissements sur le long terme. Vous avez encore 1 minute. Donc, je vais juste aller directement au but. Je voulais dire que fondamentalement, les solutions qui sont proposées par les économistes de la théorie des créditeurs pour faire face à ces contraintes, et notamment la possibilité d'allouer
Corporations, and then he suggests that countries should move ahead unilaterally by implementing a payment system, reforming international payments. So in conclusion, I think the work of our panelists can be viewed as interconnected and complementary, and it provides a comprehensive framework to understand the challenges in the realm of sovereign debt, because Christina emphasizes that any policy solution to the current crisis that is to be grounded in the interests of debtor countries must take development into consideration when measuring debt sustainability. So when determining the terms of the restructuring, we need to take into account long-term development perspectives in terms of measuring what debt sustainability means. Ario highlights that there is a strong colonial legacy in the way sovereign debt is legally crafted and how sovereign debt crises are dealt with by international financial institutions. And she stresses the importance of legal and policy approaches grounded in the local, as I mentioned before, to ensure a development-oriented approach to sovereign debt. And Basil, I think here he kind of maybe suggests what that means in practice, or could potentially mean, what grounded in the local could mean. For example, considering a reform of international payments. This reform then would enable the country to stabilize the current account and then ultimately to leading to long-term balance of payment and sustainability. So in light of those presentations, I think it becomes clear, 3 things become clear here. One is that we need legal, institutional and macroeconomic policies that are aligned and they are grounded in the local context and oriented towards solving short and longer term balance of payments constraints. We also need international efforts to measure that sustainability in a way that aligns with developmental considerations. That means taking into account longer term balance of payments constraints. And this issue is often neglected in most discussions on sovereign debt and how to deal with sovereign debt crisis. And finally, we do need concerted international efforts towards a multilateral solution to sovereign debt crisis. I do have some individual questions that I don't know if that would be, if I should include them now or later.
No, we have to go on. I have to wrap things up. We'll spend about another 15, maybe 20 minutes. We'll extend it a little bit, but not very much. The first person who wants to make some remarks is Louise Wagner. Louise, you're up.
Thank you so much. Thank you everyone for organizing this, and also congratulations from my side for the publication of this book. And thank you, Ndongo, also for giving the movement and Debt for Climate a space to speak up here. This is the movement that I'm from, that I'm representing today, and it's called Debt for Climate. And I'm super happy to maybe make the bridge today between everything that was said from theory and proposals into action, because besides of all the international policies that we need to do this, we also need a strong movement, and like the first speaker of today said, a strong working class movement in order to actually implement these things, because obviously those in power will not just give us what we are asking for. We need to fight for that. And that is exactly what Debt for Climate is doing. And Ndongo asked us to briefly present this, so I'll just take a minute to do that. We are a Global South-led movement. We are by now represented in about 30 countries, a very young movement. We were founded about a year and a half ago. And we are making the connection actually between colonialism, the debt crisis, and the climate crisis, because obviously also the debt crisis is driving the climate crisis as one of the major forces behind it, because it's driving not only extractivism, but also countries of the global south who have least contributed to the climate crisis and are affected most by it, they have to invest all their money and all the resources that they have into debt servicing and do not have any money in order to adapt, and definitely not in order to sovereignly and self-determinedly lead a way to address transition and an ecological and economic transition. So we are uniting labor movements, social movements, feminist movements, indigenous resistance movements, and the climate justice movements from the global north and the global south to demand debt cancellation in order to enable a just transition and an energy transition, with worker unions and working class people as protagonists and not antagonists of the climate movement. And very happy to be here again. Just briefly also, if anyone, we are also setting up a council of experts in order to support us that we can run to, because the longer we will be out there, the harder and the tougher the questions obviously will also get, and the closer that we get to the politicians in power and the institutions that are ruling the financial global system, the tougher the questions and the tougher the repression and the resistance against us will also be. So if anyone also from the brilliant presenters here would be up for supporting us somehow, I would be very happy to get in touch. And if you want to be part in some capacity of a future, like a council of experts, in order to help us develop the right answers to those who do not want to hear our answers. Then I don't know if I can share somehow I don't know, I think the chat is not there so that everybody can see it, but maybe we can share some contact to the movement. And I'm very happy to be here, and I don't want to take up any more space. Thank you so much for this.
Thanks so much, Louise, for making your remarks, in addition to all the other presentations that have occurred before today. And now we have time to open up for discussions from anybody. And I'll first cite a question, a Q&A that's from Juan Pablo asking Christina. Many thanks, Christina, for your presentation. Your findings are so interesting. I have a question for you. While we can learn from UNCTAD's mandate, renewal discussions that developing countries can build alliances across years, why do you think this unified front hasn't been translated into sovereign debtors club to collectively negotiate their debts toward common creditors yet? It hasn't yet happened. Before I ask Christina if she wants to answer, is anybody else can add on their questions at this point on the Q&A or use the raise hand function? But why don't you go ahead, Christina, if you want.
Yeah, absolutely. Thank you so much, Juan Pablo, for your question. It's very difficult to answer precisely, so I'll just give you some initial thoughts. And I think there's a lot more work that needs to be done on kind of debtor coalition building. One thing is maybe to understand a bit about the context of the power and the belief of UNCTAD as a possible space for radical transformation at the time. And if we go to sort of like a pre-80s period, Raul Prebisch was the first Secretary General and leader of the conference. There was a lot of hopes placed in that process, which I think become obviously stalled by the mid-70s. But there is a period where the possibility for negotiation is there, and there are some marginal gains made. So it's through the group G77 that UNCTAD is able to sit in the Paris Club, for instance. That was a big gain at the time. It was a big gain for status to be able to voice certain concerns. Another thing to just consider about this is just to think about that time. What are the channels of communication in terms of the information that's known? We know that the agreed minute from the Paris Club is not publicized. We know that anything that happens with the IMF and its member states up until the East Asian crisis, there's no mention of it at all. The public information about IMF agreements only becomes common knowledge, let's say, even to citizens of that country post-97. So there is a question about what are the channels of communication between countries in order to help build an alliance of debtors, say in the pre-80s period? If that's a legitimate question, I'd like to look into more. And just one final thing, the sort of Cartagena, consensus of Cartagena and things that happened after the 80s is sort of like a bit of a structural break in the sense that it's a regional initiative. Some of the proposals put there are actually quite similar to the G77 ones and also the G19 group proposals that have come through the CIEC, Conference for International Economic Cooperation. There are some common proposals, but there are also some specific proposals about particular issues in the sort of banking things facing Latin America at the time. So yeah, I mean, it's a very interesting question. It could be nice to trace the sort of the blockers to developing countries. So developing countries that resisted or voted against even UN process throughout the sort of decades, as well as the possibilities for mobilizing outside the UN process and the kind of aspirations, but also disappointments in that. I'm all thinking particularly of the landmark GA General Assembly 2015 9 principles for debt restructuring. They weren't unanimously agreed. So there are sort of, yeah, kind of trying to trace different interests. There's a lot of work to be done there. So anyway, I hope that that's partially helped respond to your point. Thanks again for your question.
Karina, do you want to go ahead then?
Yes, thanks, Paul. I have just adding some questions that I would like to ask the panelists, because I think their chapters were really thought-provoking in many instances, and so to Aria, I would like to ask if she could explain further or elaborate any thoughts she might have on what grounded in the local means for sovereign debt, because that was something that really I thought was really insightful in the context, especially in the context of low-income countries like Zambia. Because, for example, in the case of Zambia, I know that there is a significant portion of the debt that is technically domestic currency denominated. And this was kind of advocated by the IMF. And how can these countries balance capital account openness with the need for local policy solutions? And can, for example, copper linked clauses in those contracts be a way to kind of mitigate the financial pressures faced by countries like Zambia, which rely heavily on copper exports? In terms of regarding Christina's paper, Christina, your research points that UNCTAD and other debtor-associated fora have been unable, or I don't know, unwilling. It's not the focal point of the chapter, but they were not able to translate their economic considerations into a technical framework for the measurement of debt sustainability. In your view, why has this been the case, and what steps could be taken to overcome this challenge? And Basil, I know this is not the focus of the chapter, but could you elaborate on how the discussions on balance of payments constraints and the measures required to address those problems can perhaps inform macroeconomic analysis that takes developmental considerations into account in debt sustainability measures? Thanks.
Anybody want to answer Karina's question?
Those are fantastic questions. I wanted to thank Karina and James for their really insightful comments and helpful comments. A couple of things that I would say. First of all, I think that James's mention of the transnational elite is really important, because during colonialism, the colonial possessions weren't governed for local people. So we have in place internally in many countries governance structures that aren't focused on the local. So when I say grounded in the local, I mean giving greater consideration to the impact on local people. And we can do that in a number of ways. Part of it is we need to think about Zambia and many other countries in Africa still have economies that were based on what the British chose. I'm talking just about British colonies now. The British decided, they basically painted a map of different products that they would focus on in different parts of the world. So I think there's a pressing need for economic diversification and risk management, better risk management practices in terms of the products that countries already have. In terms of the transnational elite, part of it is focusing on making their incentives be more local based, because some of that transnational elite is also dedicated to extraction. So I think there are ways to create incentives that would minimize extraction at the local level. And I also think we need to think about legal mechanisms that would, thinking about improving internal legal capacity, and also thinking about legal mechanisms that local people, not local elites, but local people can use as an external enforcement mechanism. And that would really be thinking creatively about some of the incentives for external lenders, which I think the incentives that have now been created really don't encourage them to manage their risk in better ways. And that means that they may be giving lending that they shouldn't be giving, because they don't really have to worry about risk because they're going to enforce it in New York or England. I can talk more about it, but I know we don't have a lot of time. Those are my initial thoughts. I'm happy to have a conversation offline.
We have been told that we can extend for several more minutes discussion, so don't be too worried about time. Anybody else?
Okay, I can briefly respond to Karina's question. Thanks a lot for your great summary, actually, of what this reform is about. I know it's not always easy to understand at first sight. So basically, I would say the balance of payment and that whole issue that comes with it is widely acknowledged. And this is why we face a dilemma, right? That we want to suggest alternative development strategies different from what the mainstream financial institution propose, IMF, World Bank, and so on. And that works as long as we consider the domestic economy. But as soon as we get to include the rest of the world and the financial and trade relation, it becomes very difficult, and the issue of foreign debt is such a tough constraint. And this is where we unfortunately converge in our analysis with IMF. And of course, it's very true. We should employ the domestic policies to promote exports, to substitute for imports. All very clear. We know that. The thing is, it takes time, and to achieve success, to get at the higher level of domestic industrial capacity, you might go through periods of several debt crises because of the global business cycle, because you rely on import of technology to steer domestic industrialization. So, and my interest is in how we can bridge these problems, how we can stabilize the current account, the balance of payment. So how can I say that the problem is well acknowledged in macroeconomic debates, in the drafting of development strategy. We also know very well the reform that Keynes suggested after World War II, but it is a global reform, and we know all the solutions that are global, as much as we support them and as much as it's very true that the world needs to change structurally and systemically and so on. Global solutions take time, and for an individual country that is not very satisfying. So what can a solution for a single country look like? And this is where Bernard Schmidt, in my view, a very much underrated economist, really brings a big progress in suggesting this unilateral reform. Usually a question is, why has this reform not yet been implemented in a country? A very good question. One is that the analysis, because there's a big structure of explanation and very deep diving analysis in these publications that exist. There are not so many, but they exist, that are not very reader friendly. So I think it's very important that we can popularize these ideas. I would like to contribute to this. Like today, we can have discussion about this and think about what are the details? How does it need to be designed in practice? What are steps for implementation, and what are the experience that can be gained from it? So I think it's somewhere in the beginning. Some steps have been made, but I fully agree. We need to push more, that we can lead these debates and complement this debate about this reform use it to complement all the other structural debates that we have and that are very much true and we have heard today, and I completely agree with. Thank you.
Thank you, Basil. Does anybody else have some remarks they want to make or reactions?
If I may, Paul,
Go ahead.
Just to follow on Basil's point, I do see Basil's point about sort of working maybe what he proposes to be sort of a Keynesian sort of approach within what I would characterize as within the system. I think there's I think part of the debate within this book is sort of thinking about this problem of indebtedness with a longer historical reference point. So all the questions, Basil, that you mentioned about balance of payments, concerns in response to Karina, the use of foreign reserves in the ways that you mentioned, are problems that in the modern era have sort of date even before our current system. So if you think way back to the beginning of the 20th century, Haiti faced exactly these problems as the first Black republic. The previous system of debt collection was blockades by the US military in the ports of Venezuela and Haiti, or even just going to ransack their central bank. The modern system sort of introduced arbitration as an alternative to that. It introduced the kinds of modern mechanisms even before the IMF came into being. And you may want to look at the 1915 treaty between the US and Haiti that established the mechanisms that we see today with the IMF. I am highly skeptical that any mechanisms for reform within this system are likely to produce any significant dents or changes. They're sort of simply just going to kick the can down the road as long as these economies remain at the very bottom of the economic radar, as long as they want to still continue to play within this system. These problems are systemic, they're structural, they're not episodic. Something different would have to be done to address these problems. And I'm not suggesting the solutions are to delink, but just to suggest that there is an interesting conversation within this book between your kind of proposals, for example, on the one hand, and what Dongo proposes in his chapter on the other. And I think for me, the value of this book is that debate and not necessarily sort of resolving it and sort of hoping that that debate will be the kind of debate that we're going to see. For example, in the climate context, is debt going to be is climate going to be the new context in which the financial industry is sort of going to continue to indebt these countries? I think those kinds of debates, I think, are what makes this book really important. Thank you.
We have a couple people who have raised their hands, but I just want to mention we do have one final Q&A, which is, what is the role of regional and sub-regional institutions in securing a unified approach to addressing the debt problem? I'm not sure if anybody wants to address that, but we only really have 5 minutes. So anybody? Christina, I know you had your hand up.
Yeah, we don't have much time, so I would like to just give the floor to Charles if he's still wanting to come in at the end. And if there's time, I wanted to just respond to Karina's point.
Okay, Charles, go ahead, Charles.
It's a quick question to Basil. So the mechanics of sovereign debt payment seems to me that it's the government utilizes taxes and buys foreign exchange or from exporters or whatever source of capital flows that come in, keeps them in some form of reserves, and then debits the reserve fund for payments. So if in your story, in your example about the Keynesian proposals on not destroying capital, but spending it preferably on investment, isn't that a case about the role of the central bank generally? And could you say a little bit about that, since the central bank that really mediates this, but also functions in the context largely of inflation targeting?
Thanks a lot for this question. I hope I can respond it in a short time without becoming too technical. So a few remarks first. Just maybe useful to know as a background. Yes, the proposal is inspired by Keynes. At the same time, it addresses an important gap in Keynes' plan from that time after World War II, saying that Keynes had actually left a gap. So that reform that we are talking about here, it goes a step further and it starts with the analysis of the double payment actually. That's one remark. The second is, for simplicity in what I've presented before, I just consider the banking system as a whole, like that includes the central bank as well as commercial banks of a country. Of course, you can play around with balance sheet and differentiate, and it becomes more complex in reality, but the basic mechanisms remain the same when we just take the banking system as one institution. But now, to your question about the central bank. So let us briefly consider what happens when a country has an export surplus, or let's overall say a surplus of financial inflows. So because with the surplus, it's known better. So foreign exchange, let's say USD comes to the country, and to get to the recipient of let's say the exporter who earns the money, the banking system, and let's say concretely the central bank, it monetizes this export return. That means it receives the foreign exchange and it credits the exporter on his account with domestic currency, and this domestic currency is created out of nothing. It is the counterpart of the foreign exchange earning, and it allows this creation of money allows to credit the domestic exporter because this person has an account in domestic currency usually. So that means as long as there's a surplus, there is a source of additional money creation. And this is why we know that phases, commodity booms, for example, which lead to strong waves of money inflows, they create inflation because this will be demand in the domestic economy. For example, drives up real estate prices, okay, because there's new money to monetize the capital inflows or the export returns in domestic currency. Now, if the opposite happens, you pay this domestic currency, and the banking system or the central bank completes that payment in foreign currency. That means your domestic currency that was created during the boom goes back to the banking system. And as it was created out of nothing during the boom time, in the times of surplus, now in the time of deficit, it will be destructed again, okay? And now imagine what happens with countries which actually do hardly face any boom times, but only deficit times. They lose money every year because domestic residents, they pay in the domestic currency, and this money goes nowhere because it does not, you can pay as much as you want in domestic currency, it does not affect the level of debt you have denominated in foreign exchange. I hope that makes it a little bit clear. I'm happy to follow up and detail the discussion, of course.
I think we need to end it now. It's 15 minutes past the closure time. I want to thank everybody for all the panelists for their presentations, all the authors, and Nugo, of course, the translators, everybody who's behind organizing today's 2 sessions. It's really been wonderful for me to participate, and I feel honored to do so. May I give everybody best wishes? Thank you very much.
Thank you, Paul. Thank you, everyone.